Well, hello everybody, and it's an honor to be here at the International Economic Forum. Would just like to thank Nicolas, Stephanie, and the whole group for putting together such a great event. I'm very excited to be hosting this panel on family offices, having started with Group RMC founding a co-investing group with over 300 family offices globally. The one thing I've kind of learned as we've met many of them is that if you meet one family office, you really meet one family office, as the cliche goes. And I think we're going to have a great lineup today of panelists to explain the different stages at which they kind of evolve in their process. And they're all interesting, different stories, and so I'm excited to hear them myself. So what I'll do is first allow each of them to introduce themselves and give a little bit of background, and then we can get into the discussion. So Larissa, you're closest to me. We'll start with you.
Thanks, Nick. I'm Larissa Miller. I spent several years in Abu Dhabi with members of the royal family. I'm now CEO of an investment development and consulting firm, primarily focused around technology, infrastructure, agriculture, and agri-tech. And I work with several NFL players currently putting together a multi-family office so that they can do something meaningful with their money. So I'm looking forward to the conversation. Trevor?
Thank you. I'm Trevor Monder. I'm the CEO of Peerage Capital. We're a family office based here in Toronto. I've worked with the family for over 20 years. I was actually probably their first financial employee. And I've grown up really within the family and within the business. We really have three main focuses from a business perspective: hard asset real estate services, and asset management.
So Maxime Saint-Laurent, I am in charge of my family's family office. So we're no royal family, so maybe we need a kind of a formal introduction. We have basically three businesses. We have an operating company that does HVAC distribution. So that business was bought in the 90s and built to a North American leader over 30 years. And that business was partly sold to a private equity fund in 2014, which led to the second business, which is the single family office. Where we diversify our asset base, and the idea is to grow the assets without taking on too much risk. And that led to a third business, which is a private equity fund, where we co-invest with other family offices in different sectors, but mainly private equity, private businesses, and we take minority positions.
Fantastic. And let's not forget Ratam calling in from Israel. Very excited to have you online. I think it's midnight there right now, so tell us about yourself and where you're at in the family office world.
So I'm Rotem Hokma. I am from Israel, and I run a family office here in Israel. The family's main business is actually green energy, but I focus mainly on their investments outside of their main business, which is real estate and, of course, tech. You cannot forget tech in Israel. And we do also CLOs and hard asset-based loans in Israel.
Fantastic. Well, thank you all for the introduction. I'm sensing one theme that kind of comes out is that, we're all smaller countries from an economic perspective, and global thinking has kind of become very important in the world of business. So, Israel, the UAE, and even Canada. I'm just wondering if you can all comment kind of how you think about investing in a global world from where we are right now. And so we'll start with Ratam, since you were last.
Oh, thank you. So it's very interesting for us because other than the green energy sector, which is focused in Europe and in Israel, most of our investments are really outside of Israel. We usually look at things that are more global. Even though the tech investments are the smaller tech investments are in Israel, they're always focused on the global side, because Israel is pretty much a very small market, very local. So we mostly look at things that are outside and that we can bring to Israel, if it's possible.
Fantastic. Max, how do you kind of adapt in this global world?
Well, we started in 2014. It was mainly local because we were new in the business and we had limited contacts. So our investments were mainly regional, local, Canada, US. And as we grew and as we understood the importance of diversification, and from a geographical standpoint, we definitely went into different funds and different asset classes overseas to basically diversify that risk and get exposure to those different markets and industries abroad.
Fantastic. Trevor?
I think we take the opposite approach. We don't really like to invest anything we can't get to within an hour by car. And our kind of viewpoint is we're in a pretty massive metropolis here, 10 million people within 90 minutes. And, representing a family of some substantial wealth. But I just think it would be hard to spend $1 billion outside of an hour from here. So we tend to focus on things where we can touch it, we can work with people. We think, we're very heavily focused on service industries. And then once we can't grow it anymore inside that 1 hour, 1.5 hours, we go further. So on our real estate services, we've kind of exhausted what we can do both in Toronto and in Canada. So we've started expanding in the United States. The next step will be maybe a little bit into the Caribbean. But really it's how we think about things. And then actually, Israel is the one place that we invest from a venture perspective because, we're excited about a lot of things that are happening, and we just think there's a lot of things that can come back. But we're very passive when it comes to any sort of technology and venture, and it's top 3, top 5 in the world right now. So
that's why they call it the startup nation. Right?
Yeah. So we just think it's probably easier for us to do that than it is to try to go to San Francisco and bump elbows with the people there.
Absolutely. And Larissa, from your experience?
We're never going back to normal because normal was the problem. And what COVID has shown us is that, our community marketplace is now global. And with collaboration and co-investment being central to so many enterprises, we also do the same. We work with meaningful partners around the world, looking at projects where we can find some critical intersections between the industries and sectors that fill many of the fractures that we've seen now so that we can be leading the way as we move forward in this era of transformation rather than, stuck in the middle of the pack. I always say the middle of the road is where you get killed. So you want to try and find a way to be either out in front, charting a new path or coming together to be a collective part of a bigger solution.
Excellent. And I was noting in the call before that things are opening up even within the area between the UAE and Israel. So I'm sure there's a lot of new business links being forged.
It's a new time, new era.
Yeah. So one of the things that often comes up in the world of family office is succession and generations. And I think what's cool is here we have different generations. So we have Max, which is a good friend of G2, who in my mind is a great example of a successful leader on the G2 side, who's really taken the ability of learning from others and avoiding mistakes that might happen. So I was wondering, Max, maybe if you could just tell us about some of your experiences, how you positioned, and I know Rotham is now in a transition, so maybe she can compare notes and learn a bit later, but how did you successfully do it, and what can we all learn from it?
Well, it's a tough question because it was a weird succession where my father, which is G1, the wealth creator, was never involved in the investment side. So when he sold, he's a pure entrepreneur, and he decided he was still minority shareholder, still CEO of his business, just no longer the majority shareholder. So he stayed in the business, and basically I took charge of the family office. So there was never an official transition. There was just like an opportunity for me to take the ball and run with it. And what I did, I'm young today. I was even younger 8 years ago, right? So I felt the need to discuss and exchange with other family offices. And I went out and I talked to many of them. I saw some things I liked, others I did not. And what happened is that I had the chance to meet my partners today, which are Eric and Dave. They were basically running a similar size family office with similar strategies, similar asset allocation. We had similar values in terms of human values, not capital value. But so we started exchanging more and more information before we ended up kind of combining the single family offices to create a multifamily office. And that today allowed us to have more scale, to have a team of 7, to have an investment committee that we share, to have processes that are streamlined. And basically, for me, the big risk that was there prior to the agreement or that deal with them is that there was a key man risk because all the information was in my head. I had like an executive assistant, but I was the core individual, and everything, all the decision making was in my head. So by partnering up with them, they knew what we were up to. We could share, we could bounce ideas, and it kind of felt good for me to have that backstop if I got hit by a bus. And for them, at first, I thought they wanted to do this with me because I was super smart, but turns out it's only because I was 10 years younger than them, and they were already thinking of the transition from they are as well G2, so they were thinking of G2 to G3, and they saw that by having me in the middle, because they're in their 40s, I'm in my 30s, and the kids are in their 20s, it could facilitate that transition in the future, and kind of pass that knowledge along, and I would be there if something would happen to them. So I'm not sure if I answered your question.
Absolutely, yeah, no, that's very fascinating. So, Rotem, were you taking notes for your preparation in the transition?
I am, but I'm asking if I can follow up with another question, if I can take your job there, Nick, for a minute. But so the third generation, is it coming in and learning from what you do? Are you a kind of a mediator between the second generation and third generation, and teaching them, or having them around so that they can see what you guys are doing? Or is it just for you're there in case God forbid there is a need, and then you will teach them afterwards, or is it happening now when they're in their 20s?
Well, we want to do a transition, but one of them is 20 and the other one is 13, I think. So they're not necessarily like aware of everything, but we did put in place some classes for them to kind of get a sense of what kind of investments we do and everything. So far they're not involved, and I'm not like actively in touch and passing on information. But the idea is that we get there in the next 10 years on a gradual, like with small steps as they grow older.
And Trevor, with Miles, are there discussions with the next generation, and how does this work with key people such as yourself?
I would say, we're in the midst of considering sponsoring a chair at a university on this topic because we have spent so much time on it. I would say for our family and for Peerage, it's almost become an obsession. And the most recent, what's happened in BC, is a healthy
telecom, shall we say?
Yeah, it's a healthy reminder to, as my role is, what does he want? And it's not so simple as what's on paper. It's also about, the best advice I think we ever got was the best way to prepare for after you die is everything you do, obviously, pre. So if the people involved know exactly what your intentions are and you put the right people in place, it shouldn't really matter when it's all said and done what the paper says and everything else. And so I won't get into the kind of the family dynamics of what's going to happen, but we look at it as a business and we think about every day having a bit of that. Their last name isn't Adele, but it is who is going to take over for me. And I'm not even 50 yet, but I told him 5 years ago, you need to start hiring a bunch of 25-year-olds because someday I will be gone, and who's going to take over for me? Who's going to take over in our businesses? You name it, and think of it that way. And so whether their name's Nadell or they're a son-in-law or something else, we still have to be thinking about that, or ultimately make the hard decision or the easy decision that many, many wealthy families have made, which is, when I die, I'll just give it all to charity. Everybody will
that solves the problem.
Yeah, everybody will get a check for X.
Warren Buffett giving.
Yeah, and you use him as an example, but I always kind of chuckle because I think each kid gets 400 million or something like that. That's not a real bad number, right? When you talk about absolute dollars, well, I'm leaving 10% to the kids. Well, if you're worth $1 trillion, that's different than the guy who's worth 50 million in the next generation. And you're talking about the future of the family office, and I think the way we run our office is the future of the family office, but I think the one thing we should remember is these family offices are getting big. They are huge. This is not 100, 200 million anymore. These are $500 billion they're getting to. They will be when these people die. There's no risk that the third generation is going to be broke. which is what they were, which that's what it was about 20, 30, 40 years ago. How are we going to protect against that second, third generation? There's too much money and global participation. It's so much of it is not going to be like that. It's kind of the mid-sized ones who may be having that issue, but it's not these big families anymore. They were only a handful of them.
How does the money help them and not hurt them at that point when you know that it's not going to be an issue, that it will run out?
Well, that's a different conversation, and I think you can have a number of different criteria, but if you want to be a family member and you want to study religion, great, we'll support you. If you want to be a family member and you want to contribute to society, great. If you want to be a family member and you want to work and you want to, whatever that is, great. The only question, I guess, is the person who decides to do none of those things and just wants to be have the most Instagram followers possible without getting paid as an influencer. So otherwise, if they become an influencer, they're probably making more money than all the rest of them anyway, so it doesn't matter. But that's the dilemma I think you have. And so I have no answer.
Who gets the car collection at the end of the day?
Sorry?
Who gets the car collection?
Well, I won't get into that part, but I think people would be disappointed with so, but it is, like you say, that's the type of things you need to be thinking about, which is how much of that is miles and how much of that's become what peerage is and how we run our business, and how do you get people to come to Victoria Park and Lawrence? Well, you know what? We're investing in the community. We love it there. We hope that becomes a little epicenter of Toronto someday, and that you're phoning us for reservations at Vic Park and at the, terrace there. But it's going to take time, and I hope we're there for a long time. But we believe it's become a little bit part of what we do and who we are, so.
I just have a quick question, Nick, if I may.
Well, that's what we're here for.
We can talk cars after.
No, it's not about the cars.
Max wants to put his hat in there.
Because you mentioned that you have ongoing discussions with G1 as to what they want when they die. Is G2 involved at all in that reflection, or?
No, not yet. Now, not recently, but I've spent a lot of time with G2, being that bridge, if you want to call it, to explain what will happen upon death and what will be the expectation post-death. But what's happened is a lot of those conversations started when they were 18, 20 years old. Now they're 30, 31. It's not the same conversation. You have to update documents every couple of years because there were thresholds and there were different things. And again, everything's always changing. Like, you may have thought about things 10 years ago, and all of a sudden you wake up and go, why would I sell a beautiful Toronto-based real estate portfolio now? Like, would that be the best interest of G2, G3 to do that? Or would it be better to maintain that portfolio and keep the NOI? And when we talk about families, we see it all the time where families get big enough, we're going to have to sell an apartment a year in order to fund that requirement to the next generation just for spending. I mean, it's complicated. We have not, you said there's no only one, every family office is different. We have not spoken to one family, and we have spent in the US, you name it, no one is doing it the same way. So
speaking of very different and generational wealth, dealing with royal families in the Middle East, how does one approach that?
You're talking a family that's 5, 6, 7 generations in and fairly rooted in the appetite that they have for certain sectors and industries and so forth. And then you now start working with, professional athletes who are coming together in multifamily office structure, and they're all, G1 figuring it out at an era and time when, investment in technology is accelerating so rapidly, and what's true today is not true tomorrow, and trying to build wealth, build generational wealth, and understand, what is a sensible and meaningful investment? How do you balance it with the mandate for ESG? How do you make sure that you're pulling in those stronger than average returns? It all comes down to really making sure you have a sharp team behind you and really walking them through the educational process so that they are, really knowledgeable and active participants in the management of their own funds at this point, and understanding that and not just blindly accepting that someone is managing their funds to their best interest. And I think that's really important, is that, it is now a world where we have to be much more responsible and hands-on and looking for, I think, valuable collaborations that can help to accelerate the areas where we're looking at those new and meaningful and innovative and sometimes very disruptive new investment avenues.
Excellent. So a theme that I took out of this is collaboration, but everybody's very different. So respecting the differences and learning where synergies might exist. And you had mentioned something about ESG, and obviously this is at the top of everyone's mind, impact investing and intentionality. And I'd say one of the advantages that families do have is they have less constraints, obviously, than the institutional world. And so I'm wondering, all of you, kind of how you approach it through that lens, not just looking, at the financial returns, but, things beyond. And so within the experience of the family offices that you are managing, and also while working with others. So we'll start in Israel since it's late.
Well, I think because the focus of the wealth generator, the principal, who, by the way, passed away a few months ago, and this is why we are in the middle of the transition, but the focus was green energy. So this is a big part of the wealth, and I don't think there are two different things between making impact investments and making the returns that you want. So we still keep doing the tech investments that are making the world a better place, the impact investments, and that's focused in Israel. We do the green energy, which is a big part of our wealth. And the rest is are things that we do just because, they're interesting for us, not always just impact investments.
So we're going to get to the impact, but can you talk to us a bit about the transition and how you're finding it and whether or not you picked up some tidbits that might help in the process, not to put you in the spot?
Well, what happened was the principal of the family office passed away at a relatively young age, and his kids, who are between the ages of 20 and 30, they weren't really involved at the family office, in the family office thing. And this is why this year has been truly challenging from an emotional point of view, from whatever is happening also in the world, obviously with COVID, and from just a logistic point of view, because there was a lot of education needed. They're amazing, by the way. They're very eager to learn. We don't have those issues where they just don't want to do anything and just enjoy the funds. But it's challenging because now we have different methods of making decisions, different investment committees. There are a lot of areas where they don't know how they need to conduct themselves, or in the decision making process. And it's a good thing that we're there to help and support, and it's a good thing that they want to do that process, to go through that process, because that's basically the main challenge I think that family office can be in front of, where the second generation just does not collaborate. And very fortunately, we don't have that problem.
I think a large part of that is because of the work that you're doing, so that they're very lucky to have you. On this topic, I know, Max, in addition to taking advantage of the multi-family office collaboration, you created a new entity, W Investments, to maybe get better terms, or to co-invest together. Can you tell us, kind of how that's working out?
Sure. I think it seems like...
By the way, he's closing the deal at 6:30 tonight. So we're very lucky that he's taking a break.
Seems like everything we start is by accident. The multifamily office was by accident, and that fund, private equity fund, was by accident as well. We were just 5 guys, 5 family offices doing deals on an ad hoc basis, direct deals in our market. And we found that we had good results together, but we were disorganized. So sometimes we were calling 2 of them, sometimes 3, sometimes I was doing a deal on my own. So we decided after a lunch where maybe we had too much wine, that we would pledge a certain amount, the 5 of us, and we would just invest together in private equity deals. And that attracted an institutional investor, which in turn attracted other high net worth individuals and family offices. And the reason why I think it kind of picked up so fast is that our whole thesis is based on the investor base. Like we have one institutional partner to kind of have deeper pockets, but the investor base are all entrepreneurs. So we targeted high net worth individuals, entrepreneurs who built their businesses and sold, or they were either, or just investing the dividends that they took out over the years. And the idea was to kind of create a network of people with boots on the ground that would generate deal flow because they get access to information, they're high profile, so they have deals that come their way and they just flip it to us. And also to have that access and brain power when we look at a deal, we're gonna call someone on our investor base who's in the food industry. So we've got a few of those, for example, and we try to call them before doing an LOI, and we say, hey, this is what we see. This are the red flags. Based on your market knowledge, what do you see? And then we also leverage them as board members. For example, we're just to open doors for our portfolio companies. So, and to your point earlier, where I echo that the closer you are to your cash, the better it is. For me, all direct deals are local because we have that home-based advantage where we source, like we don't do processes, we try to source through our proprietary network and stuff like that. So my comment was more for outside funds where I can't do infrastructure in Asia or whatnot, you know, so I need help. But in our market,
the combination of local and global is really...
Yeah, and for the fund, we do it because G1 was really entrepreneurial. I was born in an entrepreneurial world, and I needed to do something like looking at those funds.
Being an accountant was not something that had your...
No, I don't know why. I was the most miserable accountant out there, that's for sure. I don't know how I ended up there, but it was a good training. That's I would do it again, but it was more to get, good, solid business basis, but it was never a dream of mine to crunch numbers. So yeah, that's how we brought that.
And do you find the entrepreneurs selling, do you value that it's such a unique ecosystem? Buying into their businesses.
I'm sorry.
Do you find the entrepreneurs that are selling you part of their business are valuing it, that this is a different way for them to monetize?
For sure. When they see us as opposed to another, like let's say an institutional player who's going to buy into their business, the decision is easy for them because we just show the lineup that we have, the depth that we can bring to the company, and it really, we speak the same language. As opposed to, and I respect institutionals for sure. It's a good thing that they're there, but I think we just have a direct channel of communication with those entrepreneurs.
Very diplomatically said. So, on this experience and impact in sourcing deals, Trevor, can you give us a little bit of the experience you've been having?
Sure, and just on your point, doesn't matter where they are, we pull their cash balance every day. We don't have a big focus on impact investing. We actually work a lot in our community with a lot of the entrepreneurs, and maybe this is not a popular response, or maybe but we actually say to them, go build a business, go make a lot of money, and then invest in your community, give the money to charity, make a difference. But don't feel guilty because you're actually trying to make a profit. You're 22 years old. You're trying to build a business. And everything you have to do doesn't have to be green or impact or whatnot. And I applaud that you care a lot more about that than I did when I was 22 years old. But if you build something here and you employ a couple hundred people in the community of Scarborough, you've done something. You've made far more impact than you're ever going to do by buying a Tesla or anything else. So that's kind of one philosophy we have. On the real estate services side, we have just made our first investment in a business that we hope will have an impact on 1 million. Our goal is to have an impact on 1 million Canadians and their ability to create equity in a home that they otherwise would not have been able to. So we put together a program for people who really just don't have mom and dad or G1, 2, 3, 4 to help them with that down payment.
Yeah.
Right? And we have so many issues facing real estate in Canada. And, our view is they're so supply driven. There's no quick answers. There's no magic wand by Doug Ford, John Tory, no one else that's going to fix them. And the land has run out. It's not running out, it's run out. And that, the prices that we're seeing, there's nothing that's going to cause them to go backwards. They're going to ebb and flow. They're going to do everything else. And so the idea of owning a home and the dream of owning a home is dissipating for so many people. And so we started that program in Toronto, but what we hope to do is then take that program further and make it for very specific places, like, so you have to live within 5 kilometers of this particular neighborhood, or you have to we'll get community leaders to support certain demographics. And we just think that's really, really important, because if people can own their home, it just changes the way they look at everything. And more importantly, if they can create wealth through owning their home, we think that's really, really critical. And I'll tell you, we'll do well by it too. And then we will reinvest that into more charitable, because that's our goal. Our goal is not to change the world through clean energy. It's to build another wing at Sinai. It's to build another field, a new field at Jane and Finch, to build another field in Scarborough. Like, that's our goal. It's not, because we're just not smart enough to figure out how to change the world when it comes to green energy and everything else. It's just not what we do. So
sticking to your roots, I think, is very important. And, you are doing some interesting stuff in agriculture that might be different than people would imagine. So maybe you want to tell us a little bit about that, Clarissa.
Well, you know, the Stone Age didn't end because we ran out of stones. It ended because of progress. And we have to be looking at ways to take that legacy business model, dissect it, reassemble it in a new way that makes it really relevant to the future. And you know, we have a very large agricultural enterprise in the United States now that is disrupting a sector of agriculture that is traditionally one of the big violators of, you know, greenhouse gases and not seen as sustainable, and that's the beef industry. And by taking it apart and putting it together in a new way, you know, finding ways to now be able to sequester carbon and sell carbon credits and really make the supply chain much more transparent and give the retailer and the consumer much more control, all by just rearranging and shuffling the pieces and creating a model that is decidedly different than the way it's been for the last 30 or 40 years. Controversial so in many cases, because those who have controlled the industry are now probably eyeing the brakes on my car. But, you know, this is the way we're going to have to approach business as we move forward, taking that legacy business model, setting it aside, looking at the core of business and investment, snapping it apart as a puzzle and putting it back together in a new way that makes it, you know, very dynamic and in something that will lead the way. You know, there's nothing more vulnerable than entrenched success. When you get, just ask Kodak or Blockbuster. When you get comfortable with that business model and you're failing to look at where the fractures are or ways that you can be doing it differently than everybody else, and incorporating the responsibility that we have to ESG now, responsible governance, making sure that we are having more control over our supply chain, and where possible making an environmental impact and putting our money to work in our communities, making a social impact, empowering our communities and looking at our youth to really be able to take the reins as we move forward. We've done a horrible job of preparing the future for our youth, so we have to prepare the youth for the future. And that's the G2s and the G3s that will be ultimately managing their wealth and being tasked to do it in a way that is responsible to the planet, to our societies, and to one another. It can't be us against each other anymore. It has to be us together for a solution. And whether that's investing on behalf of our own families, but keeping a mind to the fact that there are investments out there where we can come together and really be that much stronger, I think we have to be open to that possibility and potential.
Very, very good answer. And all different answers, which makes it very interesting. And going back to that every family office is different, but quite inspiring. So one of the things that obviously comes up on the family side are taxes. You know, we're not tax-exempt pensions institutions. It could be estate, you know, it could be investment income, it could be foreign issues. So maybe I'd just like all of you to maybe talk about, as Elon Musk, I think, did a Twitter poll and sold about 10%. He obviously had a big tax bill on his options. You know, where do taxes kind of fit in your thought process with what's happening right now? Anyone can start with this one. Everyone's favorite topic.
Go ahead, Trevor. Take it away.
Thank you for volunteering, Trevor.
I think that if you go back to your, 101 studies, it's amazing how little we spent on taxes, and I think they always just give you a rate you put at the bottom of the piece of paper, and then you just multiplied that. But for family offices, and I think businesses in general, but for family offices, we spend a lot of time on taxation. And everything we do, from whether it's an acquisition, family planning, you name it, the taxes are material, and they have to be, dealt with appropriately, and they have to be planned for. And it's the cross-border, like when you talk about a global world, the one thing about just investing within an hour up here, it's pretty straightforward from a tax perspective. When you start talking about buying a firm in India, you're getting into a whole new world of taxes. When Blackstone,
capital controls as well at that.
Yes, and it's you're getting to and rule of law, a whole bunch of things that we take for granted every day when we do business. And so, so of the people we have in our office, we have full-time tax. We have full-time bookkeepers who I would say their sole job is for 150, 250 companies, HST, other sort of excise compliance, 2 lawyers, and I'd say half their time is spent on tax or tax-related matters. And we still would, spend 7 figures with outside firms a year, but that's just to get started and manage it, because it's very complicated, and the world's only going to be getting a lot more complicated when it comes to tax. And for so much of what's going on, you talk about technology, they're just trying to figure out right now, they're starting to finally figure out how to tax the internet. Mm-hmm. How long has Apple and them been sending all their profits to Ireland and everything else? They're so far behind. And I know crypto was on your list. There's a whole...
There you go. We might as well
a whole tax question you can start to raise. And the good news is the U.S. has got so much crypto enforcement on taxes coming that I guess there'll be no time to spend auditing day-to-day things. But
And Max, how is your tax assessment?
Well, I would repeat exactly what he said if I understood. No, I'm just kidding. Basically, I say we plan for tax, and I never like to pay taxes. That's obvious, but I think we were just speaking about ESG and our responsibility.
Exactly.
As we're lucky, and I find we need to do it, and we need to pay taxes, and it's our way to contribute. So I'm never happy to do it, but when there's a liquidity event or something that requires us paying taxes, we're just going to do it, and that's it. We don't go overseas or whatnot. So I just see it as part of giving back to the country and to the province who actually gave us opportunities. So, but I'm never happy to pay the check.
There we go. And I guess in Dubai they didn't have to worry too much about that. But as an American, you're always fine.
I can't hide because they know every bank account I have and every bit of influx.
Worldwide income.
Exactly. Is there really offshore for an American? But to your point, Trevor, it's, for us, tax laws change so rapidly that using good outside firms that stay right on top of it and can manage that, and I can focus on looking at what I'm looking at as far as investment goes, but I want to be able to rely on the accountants, the tax attorneys, and so forth that can keep it all straight, because it's an impossible labyrinth to have to navigate unless you have really top-notch professional help on your...
And going through the transition now, are you seeing a tax impact going to the next generation and investing outside of Israel? Is that a complicated...
We had the heads up, so we were very much prepared for that event. And I agree completely with Larissa. I really want somebody who, that's what he does all day, every day, just looking at the tax planning, to be in charge of what we do in our investments. Not only that, if we do investments, of course, outside of Israel or outside of the tax region, we'll have somebody local that will work with our tax advisors. We really don't do it in-house. We rely on the people who does it from morning to evening, 24/7.
All right. Since you brought up crypto, I guess this is obviously a topic as Bitcoin's at a record high. Do you guys see that as an alternative asset for your family's wealth preservation? Talk about DeFi, you can talk about everything in the space. I'm a total neophyte myself. So we'll start with Max.
Well, thank you so much.
I know you love it.
I'm still trying to figure out crypto, quite frankly. I'm 4 or 5 years ago, some guys that were investing in crypto like since 2011, they told me just put 1% and leave it there.
And that 1% for them now is like 50% of their...
Yeah, exactly. But they had more exposure than 1%, but they advised me to put 1%, which I didn't do, unfortunately. But I think that there's something there to create value, but I can't really understand, so it's hard for me to go and to make an investment. So I'm just trying to figure it out, quite frankly. It's not easy for me. But I can see that we need to have some kind of exposure to that. And even if it's like gambling to some extent, like a small percentage, just maybe it's going to do 10x, maybe it's going to go to 0, but at least I was part of the story. That's not something an investor should say, but I'll say it anyways.
The benefit of having family offices, you just answered. You don't have the shareholders, right? So how about things with you and Miles and how you look at it?
Well, I mean, we've looked at it a number of times, so I think the bottom line is we only invest in things we can truly understand. And I think from our perspective, we don't really worry about, do we want to be in crypto and is that an exposure we want? Do we want to be in blockchain? Do we want to be in certain other things? Even ESG, clean energy, anything around impact investment. What we want to think about is, how will crypto be affected in our businesses? Where does blockchain fit inside of our businesses? And so, as a really big real estate services provider, where does blockchain fit there? And we don't want to be like 2001 where people didn't realize the internet was critical part. And now we're focused on blockchain, crypto. I mean, I'm not really familiar, like you said, but internet kind of 3, 4.0, what's coming next. That's all about finding the right business leaders, and they have to manage it. And I don't mean it from like, we need a prop tech. These aren't prop techs. These are like going to be table stakes to just manage these businesses and to run real estate services. You're going to have to be doing that. So that's where we worry about most of these things, not in a kind of like, should we be buying Bitcoin? Not that we don't have some exposure, but it's just a little bit more of what Maxime's describing, which is our investment advisors would say you're kind of crazy not to have something in the space.
There's a lot of FOMO going on, I know that.
Yeah. I would say we started with FOMO. It scared the bejesus out of us. And then a couple years later, we were like, oh, shoot. We should have done what we did. And so.
Larissa, do you have a position?
Look, I was in a region in 2013, 2014, where Bitcoin was still seen as the currency that was buying, illegal art transactions and all sorts of things. And it was something to stay away from. It was very nefarious. And now it's really seems to be taking over, especially the younger generation. I am a much more tangible. I know the stock market. That's almost like a game to me. I enjoy that. I have known nothing about the cryptocurrency side of it. Blockchain and cryptocurrency are decidedly different from one another, and the blockchain is going to be very important to every industry and sector as we move forward as the holding house, as the clearinghouse of data. But cryptocurrency, I can speak for the professional athletes. They're all trading. They're all buying.
They're getting paid in it, some of them now.
They know exactly what they're doing. I will never profess to know. I'm hoping to learn. But for me personally, it's just not a space I'm comfortable enough in to really pretend to make it a meaningful part of anything we're doing.
And are we trading our shekels for Dogecoin, or what's happening in Israel with the crypto?
We're actually the fact is that as Trevor said, we need to leave it to the professionals, and the way we're dipping into the crypto world is investing in tech and venture that deals with crypto, whether it's financing with crypto or other technologies that they develop, but we don't do the buying the Bitcoin.
Well, so there is some consistent answers. I didn't think I would find any. So we're winding down, and we live in a crazy world of. There we go. So we live in a crazy world now of meme stocks and historically low interest rates. Things might change in the future. I'd like each of you to kind of see what are the biggest concerns you see, going forward as the risks that you need to manage for the current generation and future generations. Who wants to start?
I can go.
Thank you, man.
For me, the risk in my position is it's going to come in few decades. It's the transition from the G2 to G3. I don't think that we can make enough stupid decisions to lose everything, to your point earlier. It's really about
the compounding effect is just becoming...
Well, because we're diversified, right? That's the power of diversification. I can't make enough stupid decisions to kind of lose all of it, right? At some point I'm going to be right. So I hope. But what really bothers me is how we're going to transition from G2 to G3 and how to involve the kids, when to do it, and how to teach them so that they don't go crazy or take bad decisions, bad advice. So this is really what for me is keeping me up at night. And it's actually true because they're 2 and 4, so they kept waking me up last night, anyways. But
and do you communicate that with your siblings? And is that
we do. We try to figure out ways to kind of teach them, and we tell them, but they're still young. All of we have 5 G3s. They're pretty young. They're all below 5.
I was saying for your siblings and the other siblings of the other G2s.
Yeah, but I do speak with my sister as to what we should be doing, and we try to to do that for those 5 G3s. But I mean, there's no clear answer, but that's an advantage that I have because I'm in a circle where I'm one of the youngest, so I'm going to see what the others are doing. Like I was talking about that relationship with my partners in the multifamily office. I'm going to see what they do and how they do it, what works, what doesn't. So I get to learn from everyone around me as to how to do that transition and how to educate them. So that's how I try to mitigate it, but I guess it depends on the child as well. So
absolutely. And big concerns, worries, Trevor?
Not family-wise, I think can summarize everything you said with being richer is not as good as being poorer is bad. And so I think we're just trying to identify big risks and stay away from them. We can manage through smaller risks. We don't try to predict where inflation's going and what are interest rates going to be and everything else. We're all very worried about pandemic risk, which has obviously been proved to be okay for us, but not for a lot of other people. But so that's from a risk perspective, how we think of things is just trying to think of, like right now, definitely one thing is China. We are definitely a little bit worried about what impact that will have on kind of the globalization of the world.
Or deglobalization.
Yeah, Taiwan and China. And we are in the storage business, so globalization is not the best thing for us.
So we have about 40 seconds left. Any black swans that we need to be aware of that we should be planning for?
Well, it's just, looking at everything you have and trying to have a pivot strategy in place that you may or may not ever need. Try to anticipate some of the fractures. As we've seen with COVID, there's a lot that we can't anticipate and that we never see coming. But if you're not prepared and you don't have a multitude of different avenues that you can pivot to, you're really in trouble. So it's just about having a good risk management plan in place.
And Rotem will give you the last word. It's late.
Well, I guess diversification is the way that we deal with trying to avoid high risks. Diversification. I'm going to be very short because I think we're out of time.
It seems like common sense is common practice in this group. So that's definitely something you have all in common. So thank you all for the time today.